Hi, guys. Welcome back to another episode of the Pi Podcast. I am your host, Irene. And as usual, please share, like, subscribe, share your stories as well. Invite a friend and a friend of a friend if you do enjoy the content that we're putting out and if you are learning significantly from it. So, last week we spoke about cash. We spoke about the rules and regulations surrounding cash. We talked about the limits that you can have to ensure that, should anything in the area of insolvency happen to the institution holding your assets, then you definitely have a way to be compensated for any related losses. From there, we said that we would proceed to talk about investments, and that's what we're going to do on today's episode. We're going to split this into two different sections. We're going to talk about pensions, and we're also going to talk about investments outside of the pension industry. So let's get started with investments that sit outside of pensions. I'm going to use an analogy to help translate this in a non financial way, just to simplify it for the wider audience. Imagine that you're an individual who wants to own a piece of land and farm on it, and you're not necessarily trying to grow one specific type of crop. You're probably growing different types of crops on there. You probably have animals as well. And so you're generally a farmer in that sense who's dabbling in all sorts of different crops and plants and animals. But before you get started, you have to ensure that you obtain the land. And to obtain the land, you normally go through an agent or a broker. And once the agent or the broker has sourced the land, you go through the transaction purchasing process, and essentially your title is held at the land registry office. Now, that will prove that you are the rightful owner of those assets, of the land essentially that you've purchased. So, how that translates into the investment world is this: don't try and overcomplicate it with the purchase of land, because I know there's so many elements involved in there. But for simplicity purposes, let's just deal with the fact that you have an agent who is brokering the transaction for you to purchase a piece of land, which you're going to use to farm on. And the title of that land, ownership of that land, is essentially held at the registry office. So let's directly translate that into the investment universe. In the investment world, you have an investment firm. The investment firm is going to take your funds as an investor, and they're going to invest it for you across multiple assets. And in the process of this, the assets are safeguarded by what we call the custodian. So there is a relationship between the investment firm and the custodian, and because of that relationship, there has to be a clear distinction between the investment firm and the custodian. If the investment firm was to go bust, then your assets are held by the custodian, which means that you should be secure. There's a regulation surrounding that called the CAS regulation, and this ensures that there's a clear segregation between the client assets and the business assets. Being that the firm is a business, they obviously have their own assets, they have their own accounting books, and within their accounting books, you should never find client assets sitting in there. The investor being the client, because the client assets are accounted for at the custody level by the custodian. Now, that might be complicated. So, to break this down, using the farming analogy and the land, so the land broker is the investment firm. So this is going to be essentially the Hargreaves Lansdowns, the Vanguards, AJ Bell, Nutmeg, so on and so forth. These are the investment firms that you use to get onto the investment platforms where you want to go and proceed to make your investments. They do not hold your investments. They are essentially a broker in that sense, connecting you to the market where you can buy your assets, which are then held in custody by the custodian. So they help you broker the piece of land. You then become the owner of the land being the assets that you are purchasing, right? So we talked about you being a farmer who wants to farm, say, plants, you want to keep animals, you want to farm, different types of plants, different types of animals, and so you have diversity within your farm. As an investor, because you want to have a diversified portfolio when you're investing, the diversification of crops and animals represents the diversification of your investments. So you could invest in bonds, you could invest in stocks, you could invest in real estate, and so on and so forth. Now, moving on from there, once you've invested in these assets, they are then held at custody level. Now, with a broker agent, presume that they also have a land manager who is then going to manage the land for you, because the purpose of the investment firm is also to ensure they're managing the assets for you. So they understand your risk as an investor, your risk appetite as an investor. And based on that, they will say, well, as I spoke to these clients, they wanted to have an investment portfolio which potentially has 50% sitting in equities, 20% sitting in bonds, 10% sitting in real estate, and so on and so forth until you get to 100%. So they will do what we call rebalancing your portfolio over time. They will maintain that split across your investment portfolio to make sure that it doesn't hold too much or too little in any given asset class based on what you require as an investor. Now, let's assume that the investment firm or the land broker goes bust. They stop being in business, things don't work out so well for them, and essentially they're out of business. Now, what does this mean for you as an investor? A couple of things here that we need to have in mind. We've already talked about the fact that custody of the assets is with the custodian, and in the farmer's case, the land registry is holding your title. So if the broker agent or the farm goes bust, then you still have your asset. Your land and your farm has not disappeared. That is still there. Your investments in your equities, stock, bonds are held by the custodian. That is still there. So there shouldn't be any issues in terms of a farm going bust and your assets completely disappearing. Actually, because of that segregation, it just means that if anything was to happen to this business, then you just need to move to another broker, another land broker, who can then bring a land manager to continue to farm your land for you and to maintain your crops for you to ensure that they thrive. This is the same thing with investing. You just need to get another farm manager, another asset manager, another, investment platform to manage the assets for you, because they're still held at the custody level and you still need somebody making those intricate decisions for you in terms of rebalancing your portfolio, making sure that you have the right split of equities, bonds, and so on and so forth. Now, the trick here is to ensure that the land manager that you're working with is a licensed manager, or the farm that you're working with is regulated. And when it comes to investing, the regulatory bodies that you're looking at, particularly in the UK, are the Financial Conduct Authority, the Financial Services Compensation Scheme, and the Prudential Regulation Authority. And these are the bodies which will make sure that there are procedures in place to ensure that the firm who's transacting on your behalf or who's managing the assets on your behalf is regulated to do so. And provided that box is checked, that they are PRA or FCA regulated, you should be okay. FSCS will then come in when it comes to compensation. Now, let's say that this farm has gone bust and you are working with a regulated farm. Your assets are in custody, they're safe. And to translate this into farming, it just means that the land broker has gone bust. The title of the land, actually, no one can come and say, I own this land, because the title of the land sits at the land registry and the crop is still being farmed. And so you still have, by having ownership of the land and being essentially the owner of the, crops being farmed, then you continue to be that rightful owner. Your assets do not disappear, or your farm and your land and your crops do not disappear because the agent broker has gone bust, provided that they were regulated and they did all the right things to secure the land on your behalf, and so on and so forth. So, with that said, now let's think about the performance of your assets. So, if you have crops and depending on the season, depending on what's attacking them, maybe your chicken gets some sort of infection and they have to get antibiotics and they don't fare very well. Potentially, some of them die, some of them, continue to survive. You would have made a loss there, and that's how you measure whether your land or your investment in your farm is performing well. You might be farming beans or tomatoes or vegetables, and there's an infestation, or there's weeds that come and attack them, or insects come and attack them, and the crop does not thrive, or it doesn't rain and the crops don't thrive. It's just a dry season, and you'd potentially maybe harvest 10 sacks of beans, but for this season, you only harvested like 3 sacks of beans. This is what we call performance of your assets or performance of your investments. With performance of stocks, you essentially invest in the stock market. Based on how the market performs and the decisions made by your investment manager, you could either gain or lose. If you are in a position where performance has not been great, say for example, you're saying it didn't rain, so the crops didn't thrive. If we say the market is just performing terribly because of different macroeconomic conditions, you could say maybe COVID is one of them, so the market has declined. That's a performance issue that is not recoverable. No one has control over that. Even given your best efforts, you cannot control the fact that it doesn't rain. You cannot control the fact that there's a macroeconomic condition or microeconomic condition affecting performance of the stock market. Because of these conditions, actually companies in some events might go bust because they cannot, sustain and push through that climate. However, on average, if you do find that you are in such an environment, then you just have to ride it out. Provided that the company you're invested in is able to push through that climate and, sustain their performance over time, you will then find that your assets pick back up in the next cycle because the business will continue to grow. They'll do their best and they'll work really hard to make sure that they survive. Now, with that said, performance of your assets is not anything that is compensated for by any regulatory body because you understand the risks of going into business to be a farmer, you understand the risks of going into the stock market to be an investor, and you know that either way you could gain or you could lose. And based on performance, based on the climate, economic conditions, that just is what it is. However, say for example, you dealt with a rogue broker or a rogue firm and they purchase land or they help you purchase land and they purchase land that was already owned by somebody else. They did not do their due diligence. In the investment world, if you are to work with a firm and they display a regulated firm, let's say if you are to work with a regulated firm and they display aspects of negligence, of perhaps fraudulent activity, perhaps money laundering, perhaps they even give you terrible advice and they tell you, bring a polar bear and, put it in a farm in the Sahara Desert and the polar bear just dies because they've given you such terrible advice or because they've been involved in activities that are not considered to be in line with the regulatory requirements, then you have a leg to stand on. And then the FSCS is going to come in and compensate you for those reasons and those reasons only when it comes to investments. So, provided that the firm you're working with is either FCA or PRA regulated, and you become a victim of perhaps fraud, perhaps bad financial advice, mismanagement, money laundering, then you may be compensated up to £85,000. However, the compensation amounts are dependent on different time periods. I'm going to put a link in the description section that will help you understand how much compensation you would be entitled to should you be a victim of any such circumstances. So, I hope that makes it clear in terms of your investments because they are ring fenced and held by the custodian. Actually, you should be in a position where your assets are safe. So I thought it would be useful to show you a list of companies that have failed or are under investigation for different reasons. You can see on the FSCS website it's listed very clearly. This list is quite exhaustive and it goes, I mean, if you look at the companies that are listed here for 2025 alone, that's quite significant. We're only in the first half of the year and the list just goes on. Now, as I've said, it's a very exhaustive list. Just to take you right to the end, it goes all the way to 1988. And so the records have been kept quite well and quite clearly. If you did want to go and do some research, you can find the information here. So take this as comfort that the regulatory bodies are doing the best that they can to ensure that you're protected. And so the only thing you then need to worry about once you've done your due diligence on the firms that you want to invest in or invest with is now think about the performance of your assets, how you select your assets, and building that generational wealth. So, thank you so much for joining us today. I'm going to stop here for now. I have attached the pensions video separately because it might be a lot to take in one sitting, but if you do feel that you have the capacity to listen to the pensions one as well, please go ahead and watch it or save it for next time and come back and pick up where you left off. Learn about the protections that you do have in place for your pensions and ensure that you really understand how you can recover any assets or what protections are in place in the event of any adverse events happening. So, thank you so much, as usual, for staying with me through this episode, and I will see you next time. Bye for now.